Are you ready?
Ready.
All right, let's go. Kevin here, top 100 financial advisor and best-selling author. We are here to talk about the stock market. Index funds and individual stocks. Which one is best? Which one should you choose? And how should you decide what to invest in as a whole? It's one of the most popular questions on the investing interweb. So today, we need to discuss what are the differences between the two, which one should you choose, and then obviously the pros, the cons, the costs, and everything in between. And we're going to try and do that in 10 minutes or less. So let's go ahead and get started. All right, so index funds, actually no, let's start off with stocks. So stocks are individual companies that you own shares in. So for example, I can own one share of Netflix, one share of Procter & Gamble. And when you look onto the internet, it'll say $200 per share. I can own the whole share, or I can have what is called a fractional share of that company, which means it's $200, but I only get 50. So I invest my $50, I own a fourth of that share, half of that share, so on and so forth. If the company grows, they get more subscribers, more customers, they sell more stuff, the value of that company will grow and I can sell it for higher later down the road. Now, sometimes that down the road is tomorrow. That would make you a day trader. It could be a few months from now. That would make you a swing trader, or a year or more. And in that case, that would make you an investor, at least in my opinion. That is what a stock is. Now, some stocks do great, some stocks do terribly. It depends on the year, depends on the industry, a whole bunch of other things in between. Now, that comes with a little stress, and it comes with a little anxiety. And the reason is because, for example, if you asked me last year around this time, do you think that Meta, which owns Facebook, which at the time was known as Facebook, then it changed its name to Meta last year, but in either case, do you think that one, Facebook would have changed its name? The answer would be no, I didn't think that was going to happen. And then two, do you think it was going to lose 70% in a single year? I was like, no, wouldn't have thought that. So the risk is when you are choosing individual stocks, you could be wrong in a major way. Other times you could be right in a major way. We talked about Enphase and a bunch of insurance companies. T-Mobile was one that was up double digits. Progressive. Like, sometimes you can be right, sometimes you can be wrong, and sometimes you can be right in a big way and then wrong in a terrible way. And that can come with a lot of stress and research. You are going to have to take the time to figure out what these companies do, how much money do they make, are they good at what they do, when to buy them, when to sell them, and then how they fit in the overall stock market. Now, some people are really good at this. Some people are medium at this, and then some people are obviously quite bad at it. In fact, when you are looking at professional investors or even people who consider themselves day traders, we're talking more than 90% of them fail and lose money or underperform the stock market as a whole each and every year. It is a high failure rate. Now, what is the opposite of that? What is the alternative to growing your money in the stock market without having the stress and research and burden of trying to choose one stock at a time? Because again, that is really hard to do. The other side of that is what's called an index fund. And an index fund was an innovation or an invention that I think started in the 1960s or 70s. And basically what that said was, instead of you trying to choose your own stocks, what if we just took all of them, put them in one nice package, and boom, hand it to you as an investor? That's what an index fund is. For example, VOO is one of the more famous index funds, and it tracks the S&P 500. So the 500 largest companies in the US, instead of you trying to pick which one is going to do well this year, you can just package it, get all of them in one simple investment, and do almost nothing else, and your money historically would grow at about 7% a year. That is the advantage of an index fund. Or an index fund. What is the disadvantage? Well, number one, almost all of them cost money. Now, very little money. I'm talking like, I think on some of these index funds, they charge like 0.03%. So we're talking, what is that, a dollar? Or I'm sorry, a penny for every $100, or 3 pennies for every $100 you put in. So like, it's a ridiculously small fee. You can do the math, but in either case, it's almost negligible. Like, they are almost free. And in some cases, I know Fidelity has a bunch of free index funds that you can invest in as well, and that's another way that you can do it. So in most cases, damn near free to almost free to invest in these index funds. Now the question is, well, if all these index funds are out here and they usually will beat professional investors, they usually beat the person on the street that's investing, why in the world would anybody invest in a single stock? Why would people do that? Why do you, who does 250 videos a year, why do you be talking about stocks to begin with if index funds do exist? Well, one, I've said this before, I've been candid about this. I have the majority of my money in index funds too, but I do invest in individual stocks as well. You can do both. You don't have to just choose, but if I had to pick one, I'm going with the index funds because the fear of being wrong and the cost of being wrong and the reaction of being wrong hurts a whole lot more than the cost of being right and the benefits of being right. And there are tons of studies that confirm this. I will always remember in 2022, Facebook fell 70%. Now, I also had Enphase at one point. I had T-Mobile. Y'all saw when I sold T-Mobile in public, I made money on that one. There are a bunch of stocks that I had that made money. Do I remember the exact percentage? No, I don't. No, I don't. And I say this all the time. We remember the avalanches, the hurricanes, the terrible days, but all the great things that happened in between, yeah, you don't always remember just the regular, normal days. I had Progressive. Progressive was up, I think, anywhere between 14 to 16% last year. One of the better investments that I had. Do I feel the joy and win of that more than I did the loss of Adobe that I had that lost like 28%, or Intuit that also lost, that was supposed to be one of the best stocks? It wasn't, right? So that is the risk here, and a lot of times people feel that risk, myself included, and we remember that pain a lot more than we remember the gain from some of the things that do incredibly well. But the other reason why people actually do it is because of the growth factor, right? There, if you were into oil stocks, something like Oxy Petroleum, it was up more than 130 something percent at one point. Do you want the 100% or do you want the 20% drop that an index fund gave you in 2022? It happens. So it's really a balance. What is it that you want to do? What are you capable of? And what do you feel like doing? Index funds are very low effort, very automated. Again, I would say if I were to look at my portfolio right now, I would say about 70% of the money that's in stocks, equities is the fancy term for that, about 70% of it is index funds, and then the other little 30% I use and I try and do just a little bit better than the index fund by investing in some of these individual companies. Maybe it's Apple, maybe it's Google. I'm not really big on Amazon anymore, and I try to just pick little stocks here and there just to do a little bit better than what an index fund gives me, because of the downside. Another downside, of an index fund is the fact that when the stock market is down, it's just down, and nothing you can really do about it, right? I can't help that, right? However, if I'm on individual stocks and say, well, the stock market may be down, but I'm pushing all of my money to X company, or I'm going to buy certain companies and all those companies do well. For example, if you were perfect and nobody was, you could say last year, I'm putting everything into energy. Electric companies. I'm moving everything into, I keep bringing up Progressive because I just saw a Progressive commercial, so I'm just going to go with that one today. But I'm going to push everything to Progressive. I'm going to get out of technology and just put everything in super safe investments. Smuckers, right? SMJ, because they make peanut butter and jelly sandwiches. I'm putting everything there in 2022, and you actually made a lot of money from doing that. Problem is, it's hard to do that right every single time and do it with consistency, because every year, usually, the theme changes, the game changes. And we talked about this before as well. 2020, it was stay-at-home play, right? That was it. Everybody was doing that, where Zoom, some of these meme stocks started to come out, GameStop, stuff like that, did incredibly well. Peloton was amazing in 2020. Then 2021, 2022 came, and Peloton lost 90%, right? The game changed, and it went from stay-at-home stocks and tech stocks to stocks that made money, right, as interest rates start to rise. It went to infrastructure stocks, which are doing well right now, like John Deere, right? So things do change from year to year. You can make a lot more money. Or rather, the phrase I like to use is possibility is not the same as probability. Now, if you ask me, I think your probability, the chances of you being right more often than not, are higher if you subscribe to the channel than just blindly going out here and just throwing darts at the wall. But in either case, I think the real answer is if you have to pick one, go with the index fund. just keep investing. It's going to work, and history has shown us that it almost always works. But there's also room for balance. You can own both. In some cases, it can benefit you. We've done a lot inside the members only, where I've shown you where I've beaten the stock market many a times. It's not something that happens every day, but it does happen more often than not, because I own index funds, and more often than not perfect, not perfect at all, but there are times where I'll have some stocks that give me another 2 or 3% bump over an index fund and over the S&P 500, which can help from time to time. So when you are investing in both, you are also risking both, but you do have to be careful in what you're investing in and how you are investing in those. The last thing I'll say as I'm reaching my right at my 10-minute mark is this. A lot of times people get confused between an index fund and an ETF and a mutual fund. Okay, so ETFs stands for Exchange Traded Fund, and mutual fund is all these stocks put together. They are cousins. Both of those can be an index fund. I can have an index fund ETF, or I can have a mutual fund, or just an index fund. They are both the same. They will do very, very similar things. The technicalities behind it are different. The returns are almost the same. It's like having a Ford truck and a Chevy truck. They both trucks, right? One's a Ford, one's a Chevy, but they both trucks. So that's kind of how you want to look at it. So when somebody says index fund, don't get caught up, well, is an index fund an ETF? Yeah. Is it index fund a mutual fund? Yeah, technically, yeah. They're both trucks, okay? They do the same thing. One looks better compared to who you asked. One looks better than the other. One's a different color, so on and so forth. But that is the major thing. Again, trying to fit this into 2 minutes and 10 minutes between what is it for, or how do you choose between investing in individual stocks and index funds? What are the differences and things that you could consider? All right, that is it for me. I'll talk to you later.